Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me today is Lenore Hawkins of Tematica Research, a regular guest who comes on to share her views on the global macro economy. We also have had the added benefit the last 8 weeks of getting her take on what life is like quarantine inside the Italian hot zone. Lenore, thanks for coming back on.
Thanks for having me.
All right, so we can't start any episode here during the pandemic with you without first getting a current snapshot of Italy. What are you seeing?
So last Monday was the first day that we were allowed, which I can't believe I'm actually using these words, allowed to go outside for anything other than just to get groceries or medicine. So that was a really big, very exciting day. It was pretty funny. Everyone was out just to be outside for once. What was a little stressful was not everyone was wearing a mask, and we're still required to wear one when outside at all. But that sort of changed. The first day, I would say maybe 15% of the people were not wearing a mask. Over the weekend, I went for a really long hike because, my God, it's so nice to be outside. And everyone was wearing a mask. I was actually really surprised how many people were. And today I went for a run. Again, everybody's wearing a mask. So that's probably a good sign. I mean, granted, this is not something I want to do, but I also want to keep the economy open. And if this thing is as contagious as it sure seems like it is, one of the ways to keep it open is to not have us infecting each other. So it's a good thing to see those masks. As far as for the rest of the economy, restaurants are not open except for delivery service, so they can finally do that. Retail is still not open other than stores, and thank God, enotecas, so we can get wine because it's a pandemic and you need something to get you through.
Essential services, Lenore, essential services.
It's an essential service. Don't argue with me on that. Those are the clothing shops and all that is supposed to open up in the next week or two. And hopefully we're going to get hair salons open because it's been since January since I had a haircut. And they actually had, it was funny, in the local paper, salons got together and they took out a full-paged ad saying, you've got to let us open. If you don't, many of us will never open. Those jobs will be lost permanently. And you're going to end up with people who aren't licensed actually doing the work and potentially harming people even more because unlicensed people will go around to people's houses and do it for those of us who are getting desperate enough. And we also had, I think the funniest thing was the mayor of Laulio. So when you think of Lake Como, because I'm on Lake Como, it's like an upside down Y. And the town of Como is at the bottom of one of the legs of the Y, and this town of Lecos on the other. And then Bellagio, which everyone's heard of. Bellagio is right where the two meet and then kind of goes up. Well, there's this town a little bit north of there called Laulio. Laulio is where George Clooney has he actually has two villas there with a little bridge that connects the two of them. And the mayor of Laulio went on Facebook begging George to come back for the summer to try and help get tourists here. So there's a lot of desperation right now.
I can relate. I mean, we're several weeks behind you. The lockdown has not been as oppressive, but I'm super curious about exercising with a mask on. Are people literally running with like a cloth mask over their face?
Yes. The one thing you can do is if there's no one around, like no one at all, you can kind of pull it down a little bit, which I was doing today because I went for a run in pouring rain because I mean, the Italians are kind of like, they're kind of like the Wicked Witch of the West. They don't really like to be out in the water at all. So I figured I was pretty safe to be out there and there was hardly anyone around. So I could pull the little mask down. But yeah, running with those damn things on, it's like hypoxic training.
All right. And then so when you're out and about in the town, walking around, everybody's trying to keep your 6 feet, right?
Yep.
I imagine if you said everybody was out, that had to be really uncomfortable. What are the social norms now? If somebody doesn't have a mask, are you just now veering away from them? Are you fussing at them? Are people getting chirpy about not wearing masks?
No, surprisingly, I actually thought people would be a bit more chirpy about it. And I didn't really see anybody behaving that way, but people definitely are giving each other a lot of room. And it is awkward in parts of the town where things kind of shrink down when you're on a walk, like through a park area. It does get a bit awkward. But everybody's just dying to get outside. And you do have the police patrolling pretty good. Again, not in the rain, which is why I went out, because they're just as bad as everyone else. They hate the water. So I didn't have them out today. But they're patrolling a lot. So you really have to be wearing it. I think that may have been why people started wearing more masks. But mostly it's just everyone is desperate to get the economy going. And signs are that the economy here is going to be hit even harder than the United States. But Italy's going to be, unfortunately, I think most likely in a very, very deep depression.
Mm-hmm. Well, that's a good pivot to start talking about things that you and I actually enjoy talking about.
Yeah.
I'm going to throw up the cover of the most recent edition of The Economist. Now, I used to be a big fan of this publication. Then they got very political, so I just kind of stopped paying attention to it. But this cover was making the rounds on social media over the weekend because, Lenore, I think it speaks to the problem. And so here's my question. Could we have an economic depression and the stock market still go up?
I think for a time here and there it will. This stock market and the participants in the stock market have, we can't neglect how people have been trained. If anyone over the past 10 plus years, if you actually invested on the idea that fundamentals mattered, you could easily get killed. If there was a pullback in the market and you looked at it and said, oh, well, this pullback is for a very good reason, I think there's cause for concern, you got killed. Anybody who didn't buy the dip got killed. And we just saw that happen yet again. We're facing a massive global pandemic and you needed to buy the dip. I think that's an unfortunate side effect of all the central bank stimulus we've seen, is that there's this massive dispersion between the fundamentals and the market. But I will throw in there that the market isn't necessarily everything that it seems if you just look at the headlines. We also have the most concentrated market since the 1999 dot-com bubble, with 10 in the overall 10 of the largest stocks representing about 44% of the NASDAQ market cap. I mean, 10 stocks, 44%, that's enormous. And those 10 collectively have a PE of around 50 on 2020 earnings. I mean, while the NASDAQ's up for the year, about 75% of those stocks are still negative for 2020. So while the headlines look good, underneath isn't quite as good. And looking over at the S&P, you've got the big five, right? Microsoft, Apple, Google, Facebook, and Amazon. They're up collectively around 10% for the year. And while the rest of the market's still pretty much down, they account for about 20% of the overall market cap. That's, again, highest concentration we've seen since 2000. So it's not necessarily as rosy as it looks. What we did see, though, as we're looking at this big dispersion between the two of them, looking at what happened with GDP now. So based on what we saw with the unemployment report, GDP now, which is the Atlanta Fed, takes a bunch of data. So there's no discretion in this. This isn't some guy sitting down going, what do I feel like? It's they have a calculation. It's a formula to figure out what GDP looks like it's going to be in the coming quarter. And they're saying now that GDP for the second quarter looks to be a 34.9% contraction. Now that's down from an estimate for 17.6% just on May 5th. And that's because of what we saw with the unemployment numbers. I mean, that is an economic contraction we've never seen. But we keep hearing from everyone, well, it's fine. This unemployment stuff doesn't matter because everybody's going to get rehired again. It's just going to be a little blip. So let's look at what we actually saw with those jobless claims. So I did this little chart that Jay can put up that has what the median, what jobless claims used to look like, what the max we had before all this craziness started happening. So the median's in purple. The max jobless claims we'd ever had in 1 week is the green. It just gives you an idea of how astronomical the level of job losses have been since this whole thing started happening. We've had, over the past 7 weeks, a total of 33.5 million initial claims. And if you take that number and you look at what the total civilian workforce looked like in February, that's about 1 in 5 jobs. That's just 1 in 5 people losing their jobs in a matter of 7 weeks. We've never seen something like that.
And Lenore,
Yeah.
you think about the construction of the PPP program.
Yeah.
A lot of jobs are being saved in May. They'll be saved in June, but then there's nothing after that. So how do you see this chart obviously being impacted, but to what degree?
Yeah, I think this belief that because people filed, there was about 16 some million of the Friday's report said that they were unemployed temporarily, right? They'd just been laid off. And the market's looking at it saying, well, that's, it's not so bad then. I think that's very optimistic. When you look at how many companies are just never going to be able to open up. One of the biggest hits was actually in hospitality. So think restaurants, hotels. When it's not going to end exactly until we have a vaccine. But when we start trying to get back to work, restaurants are not going to be able to operate the way they used to operate. They're going to be having to operate at a fraction of the capacity they used to be at. So you're not going to hire all those servers right back. You're going to have retail. What we have here, I know you guys said in the US, it hasn't been quite as severe as here. But think about retail opening up. You're not going to have as many people being able to go into a retail establishment as you used to be able to have because we have to maintain social distancing. So that means you won't have as many customers at once, which means you don't need as many employees in there as once. And those are the areas that have been hardest hit. And while everyone's talking, and understandably, that this thing has been very regressive, meaning that those who are paid kind of the least in society are the ones that have been hit hardest. That's really more a matter of time. When we look at like BA, how BA is cutting, British Airways is cutting a massive amount of their flights. You've got Disney's going to be making some huge cuts as well. Over time, it's very easy to temporarily lay off those who are the lowest paid because they're a little bit more easy to replace, right? They're easier. It's tougher to replace a CEO than it is to replace a guy taking tickets.
Yep.
But over time, as it sinks in how bad this is and how we struggle to really get the economy going, you will see those higher end jobs also going away.
And Lenore, did you see those images coming out of Disney? I guess it's Singapore or wherever it was.
Yeah,
So
in Beijing.
In Beijing, is that what it was?
Yeah.
All right, so they opened up with 25% capacity. They had these big yellow squares you have to stay in for social distancing.
Mm-hmm.
Everybody has a mask. Like I understand that they were booked to capacity. They sold all their tickets, but that just doesn't seem like the same experience. And a quarter of capacity with the same operation cost. Like profit margins are just going to get crushed as these companies open up too.
Exactly. And these companies, so not only do you have a lower customer count for Disney, for airlines, for restaurants, for hotels, you have lower capacity, you also have a higher costs, right? Because if you're a hotel, your cleaning costs have gone through the roof. If you're an airline, the cleaning costs, right? You have to behave very differently. Even restaurants and grocery stores, like here, if I go to the local grocery store, very few people are let in at once. We all have to keep apart from each other. And they have employees there that are doing nothing but following you around, cleaning anything you've touched. And that they didn't have to do that, right? So like you said, that's additional expenses. So expenses are up and your pool of customers at any one point has shrunk dramatically. So margins are going to get killed. And yet we have these sky high PEs, which it makes no sense right now. Mm-hmm. that big divide. And people were also talking about, well, the unemployment rate hit 14.7%. Well, that 14.7% really underestimates how severe it is. Now that is the highest we've seen since World War II. But it actually would have been 19% if we hadn't had an enormous drop in participation. So we just saw the biggest drop in labor force participation, again, in recorded history. And the labor force participation is now down to levels we haven't seen since the 1970s. And that was before women really became a significant portion of the workforce. So the percent of the population that's actually engaging in work right now is back to where it was in the 70s. I mean, this is This is something we haven't yet seen. So you put all that together, and Friday, the Dow gained 455 points. Of course it did. Talk about a huge divergence.
Yeah.
And so you were saying with those costs going up, right? Well, EPS for the S&P for 2020 has fallen from about 175 at the start of the year to about 127 today, which puts the PE at about 23 times. Now, the 20-year norm for PE is 16x. And on top of that, you've got those expenses. They're not going anywhere but up. So these models that are looking forward they're not taking into account how the margins are going to get crushed and be crushed most likely for an extended period of time, right? So this is, while the market looks expensive, it's even more expensive than we actually see. Then if you look at so what's actually going on with what people are doing? Well, retail sales in March crashed. They went down I think it was 8.4%. And what we're seeing is savings rate actually increasing. Of course, we're all scared, right? We've never been through anything like this, right, Jay? I mean, can you remember any time where we've ever seen the economy experience something like this?
Well, not only that, the fact that retail sales collapsed 8 point something% does not surprise me. Looking at it in context of this chart is what should really stand out. And, anecdotally, here in the suburbs of Atlanta, I went out to go and get my wife some gift cards for Mother's Day, and the stores are closed. They can't even transact in gift cards. And it just seems to me, obviously, the longer this goes on, the more damage. I struggle to see how a lot of these stores even open back up again. And then what are those folks going to do? What kind of drag is that going to have? And how long, Lenore, will that drag go on?
And that becomes a bit of a self-fulfilling prophecy, right? The longer you go without spending, right? If you used to be buying things a lot more frequently, one, you're really scared, and we've never seen the world do something like this. So that naturally makes people become a bit more conservative, and you want to save a bit more, right? Going into this, households were not in good shape to start with. So people are going to want to be a bit more conservative with their spending. And the stores aren't open, so you're not able to open anyways. Some of these stores, like you said, they'll never come back. Well, then those are people who have lost their jobs. So people have lost their jobs. You've got business owners who probably have a bunch of debt that, for those stores, some degree of debt that they're not going to ever be able to pay on. And that's a loss back at the bank. And that means money that the bank can't then lend to somebody else. And so that harms the bank. And it also harms that borrower out there who we don't even know yet, that borrower from now would have started a business. Now they won't be able to, because that money that they would have had the economy been good, the money that they would have been able to borrow, they can't borrow. So there's all of this pain that you don't really even get to see. That's kind of the hidden behind pain. That's all going to slow that spending. And the more that spending slows, the more people get hurt. Because we've got an economy that's really, really based on people spending an awful lot. And there's actually a lot of analysis too that spending has not been generated, the ability for that spending has not been generated by people's rising income levels, but more by the stock market continuing to go up, which is part of the reason that central banks really need to keep pushing that stock market up to keep the spending going.
Yeah, it seems seemingly their only driver, and we're confronted with this demographic wall here in the U.S. and across the globe, right?
Yeah.
So think about the 55, 60-year-old who had been saving diligently, had a job. Their retirement's not only on hold, it might not even be a possibility now, right?
And we have more of them than we've ever had. The US population that's over 65 is a bigger portion of the population than we've ever had in history. And like you said, they've seen their retirement take a big hit from this, right? They're also going to have to be a lot more nervous. Now, these guys have gone through 2 big hits to their portfolio in the past 10 years. Not for nothing, that's got to make you really nervous. And looking at this pandemic, which happens to also affect them more than anybody else, that also is going to restrict just their activity to go out and spend. So you've got the largest demographic, who's also a bigger of we have never had this many of the older group. They're the ones that we really need to be spending. They're not going out, less than they ever before. I mean, these guys, even a year from now, this is a group that I think it would be reasonable to think that they will be less likely to go out to dinner. Maybe just to have some friends over for dinner. Maybe order delivery of the food, better than going out to dinner. I mean, it's reasonable to be concerned about that. Mm-hmm. And people keep talking about this is going to be this, V-shaped recovery. Well, the companies themselves aren't really looking at that, because about 40% of S&P companies have all their guidance. So if this is this V-shaped recovery, why are they pulling their guidance? Yeah, it makes a lot of sense, doesn't it?
Yeah, but the stock market still goes up, Lenore.
Yeah, well, it just keeps going up on those PE ratios up until the point where it really doesn't. I mean, we've got in the US, about 12% of small businesses say that they're not going to last even another month. And 52% say they're going to close permanently within 6 months if things don't get significantly better. That's from SHRM. It's a human resource management, did a survey on that. Mm-hmm. I mean, we've never seen that. And yet you've got that bifurcation again. So we've got the fallen angels. So the fallen angels are those companies that used to have investment grade credit and that have fallen down to below investment grade credit. That group has hit a record over 150 in debt. But at the same time, so we've never seen this. We've never seen so many investment grade drop into junk status. At the same time, U.S. companies sold a record $32 billion in junk-rated debt in April. That's the biggest month we've seen in 3 years. So the market is it's a liquidity game. And of course, that's going to happen when the Fed actually violated their own charter. The Fed's not allowed to buy corporate bonds. But they skirted around the issue by saying, well, the Treasury's doing it, and we're just we're helping the Treasury get the money. They're not supposed to do it, but by doing that, they needed to do it because the liquidity was completely disappearing from corporate bonds. And corporate bonds, we've never seen so much corporate debt. So they had to go in there and provide the liquidity. And oh, look, you get more of what you didn't want in the first place. You get a whole lot more bad corporate debt out there.
Mm-hmm. Which is what makes fundamental analysis so difficult. They can change the rules, just like during the great financial crisis when they suspended GAAP accounting. I mean, that wasn't in any models.
Right. And then as soon as they stopped the mark to market, that would be exactly when the bottom was.
Yeah. Go figure.
Yeah. So if we actually look at what's really been going on with the markets, because we keep hearing about how the markets they're back in a bull market. It's not exactly. Because remember I was telling you about the NASDAQ and how you've got the top 10 really are accounting for all of this gain. So looking at the close as of last Friday, there's a huge difference between the NASDAQ, which is super tech heavy, and tech, understandably, in all fairness, tech and healthcare should do better because tech and healthcare are less affected by the shutdown. It's a lot less painful for Google to move their employees offsite, right, than it is for, say, a corporate office space REIT, right? Their business is getting hit hard, and it's going to be hit hard for the foreseeable future, given that a lot of companies are saying they're not in any hurry to bring people back to the workforce, to being in the physical offices. More
or less expand. I mean,
exactly. Sure. I mean, corporate office space, I wouldn't want to go near that with a 10-foot pole because it's companies are figuring out they can actually work productively with people being offsite, and that's good for them because then that lowers their overhead. They have a lot smaller fixed overhead. They can be a lot more flexible. Why not have a shared office space where your employees come into the office once or twice a week if you want to have them there, but they don't need to be there, say, 5 days a week, and that really can cut your overhead, particularly as we're looking forward and seeing it doesn't look like we're really going to get this economy going anytime soon. Given the nature of this pandemic, it's not like it just is going to disappear. We're going to have these measures in for a long time. If you look at the NYC Composite, which is a much broader perspective, that's still almost in a bear market for the year. It's down 18.4% as of Friday's closed. And the small cap Russell, which is the real domestic focused, So the little small cap guys, that's down 20%. It's still in a bear market. So it's not like the market is as good as the headlines make it seem.
That's right. That's right. Let's take a step back, think globally. Let's look at, you prepared a great chart on per capita GDP across the globe. Walk us through this.
So one of the things when you hear all the fussing going on in Europe, and you hear about Italy getting very angry with Germany, and Germany getting very frustrated with Italy and saying, you've got all this debt and you guys aren't managing your country very well. There's a reason behind all that, and it isn't people so much just being fussy. It's that Italy has really not benefited from being part of the EU outside of its ability to get debt cheap. But that's kind of like benefiting from dating like your drug dealer, that you can get something you shouldn't be getting in the first place and you can get it cheap, right? It's not a good thing. So this chart, I was looking at what the per capita GDP has done for these countries in the European Union, and also added the US in there just to give it a little bit of comparison. And you can see the per capita GDP at the end of last year, it was actually 2% lower than it was when the EU started, versus Germany, which is up almost 25%, just like the US over that same time, up about 25%. Ireland's been a huge winner, up 79% since the start. And it's even better, you hear how Greece, their economy is such a mess. Greece outdid Italy by like 5%. They're up 3.1%. So that kind of helps understand why Italy, their per capita GDP is lower 20 years later, and yet their debt is so much higher. That looks to me, when this is all, as this unfolds, I don't know how there isn't some sort of a default on Italian debt. The economy simply can't withstand that much debt, because when you think about what debt really means, debt is you're kind of borrowing from the future to either consume today or to build today. Mm-hmm. And this is one of the really tough things with what's going on in the US right now. People talking about, the New Deal, and that was so useful because there was all this spending and investing, and it helped the economy grow going forward. Yeah, that's not what we're doing this time. We're not borrowing from the future. We're not borrowing this money to then build productive assets, which will help the economy generate even more value going forward. We're just borrowing money from the future so that people can eat today, right? That's just an income move. We're not building anything at the moment with all of this massive debt. And that's a headwind for growth in the long term. That's really going to be hitting countries like Italy a lot more than everyone else, because they're already in such a bad state. We can look at that last other chart, looking at what the expectations are around GDP. Italy's GDP is expected to contract nearly 10% in 2002. And I would say, with boots on the ground here, that's probably pretty generous. I think it could quite possibly be much, much worse than that. You cannot have that when you have a massive amount of debt, right? So think about it as for your own home. If you've got a massive mortgage and your income's contracting a whole lot, that payment on your interest just gets more and more difficult, because it takes a bigger portion of whatever little income you have to pay down that debt. And that's what countries are facing all over the world. And that's why Italy was really pushing Germany to say, look, you need to take kind of an outsized share of our pain, so that Italy's not just dealing with its own pain itself, and that Germany's kind of chipping in. So far, the finance ministers have seemed to kind of come to an agreement this past week on that, but we still have a long road ahead of us. And I would wager this is actually one more headwind to the euro currency, and it is going to help strengthen the dollar. Because if you look around the world and say, well, what are the big things that we do know? One of the things absolutely, is the biggest short in the entire world is the short on the US dollar. All right, well, what are the other options? If the dollar, right, there's this huge short on the dollar, what else is out there too? Well, on top of that, you've got the European currency, which is going to be off and on called into question, because the Eurozone growth rates are so different, and the pain felt by the different countries is so different, that it's going to come into question if that's going to be able to make it. Okay, China. Well, China's currency is not going to be valid given that there's now this massive, growing at least war of words between China and the US, right? They're not exactly getting along really well. And the whole world is kind of looking at China saying, you got some explaining to do about how this whole thing started.
Yep.
So expect to see the US dollar continuing fits and starts, but highly likely that it is going to continue to get strong, which is the last thing that you want to see, a dollar getting stronger in the face of a massive amount of dollar denominated debt. And also, when you look at the US debt, right, you don't want to see that dollar getting stronger when the US debt level is so high.
Well, Lenore, as we wrap up this episode, I want to remind Livestream viewers that you can ask questions in real time. We're broadcasting on Twitter, LinkedIn, YouTube, and Facebook. Today, we do have a question from Ryan Florence on Facebook, and he wants to know, Lenore, do you see a scenario where the Fed buys ETFs or mutual funds?
I could definitely see them doing that. I could see them buying ETFs, not mutual funds, but I could see them getting into buying ETFs because they basically did. I mean, they're already buying junk. They're buying the corporate bond ETFs. If you're thinking, are they going to buy equities? I wouldn't put it past them. Technically, they're not allowed to do that. But technically, they were definitely not allowed to do what they did with corporate bonds. Mm-hmm. So they've already been pushing the envelope. And it's not like anyone in government is looking back at the Fed and saying, ooh, you're overstepping. We don't want that. You have an administration, a White House administration that very much wants to keep the stock market up. You have a Fed that has obviously gotten really scared and caved. You have an economy that is highly levered to need the stock market to go up for spending to go on at the time of us facing potentially one of the greatest economic contractions in history. So there's going to be a lot of pressure on the Fed to help keep that stock market up. So I wouldn't be surprised to see it.
Yeah. And just like them changing the rules during the great financial crisis, changing accounting rules, printing trillions of dollars, quantitative easing, it just appears to any financial advisor watching this that the Federal Reserve is committed to propping up the stock market. And
the last two since Alan Greenspan, Alan Greenspan started it, and it just keeps getting more and more of their report card.
Yep, that's right. Ryan, I appreciate the question. Lenore, thank you so much for coming on the podcast.
Thanks, Jay.